Michael Zuber, one rental at a time. It is January 22nd. It is Saturday, January 22nd. And yes, we do a daily financial news show even on Saturday. And hint, we even do it on Sunday. Before we get started with the daily financial news, two reminders. First, Saturday mornings are my live stream. I go live at 8 a.m. I will go for about 60 minutes. And then I will go live in our private Facebook group for 30 minutes. So I hope to see you there. Bring your questions, say hi, whatever you would like. I hope to see you there. Second, let's congratulate some people that closed deals. We got 4 done. First, Edwin and Casey, congratulations. And then we have, I'm going to say Nandai, congratulations for getting 3. She actually listened to me present back in 2019 in Oakland, California. She has since closed 3 transactions in the last 6 months. So congratulations, you get 3 of these. Nandai and one more Nandai. Congratulations, folks. Again, if you close a real estate investment property and you could say one rental at a time helped you in any way, please let me know about it. I want to send you one of those cards. I want to get you on the scoreboard. We are going to 500. We are going to hit it. I am going to write a big check to a food bank. I'm going to do something crazy and dye my hair purple, all because of you. So congratulations. Make sure you like, subscribe, comment. If you want your daily financial news each and every day in a 10 to 15 minute chunk, subscribe. Have a wonderful day. So as I sit here Saturday morning, I'm left to think about a couple of things. First and foremost, if you happen to be a stock market investor, I feel for you, especially if you are in the tech area. I think a lot of you might be asking, is the pain over? Or is the dip about to dip again? Let me know what you think. I've asked before, right? Are you buying the dip? Are you, you have capital on the sidelines. Are you putting it to work here? Or are you scared and holding, or what are you doing? I think what we are in is a great rotation. This is very similar to the dot-com experience where I turned 200 grand into 40 grand. I have been trying to warn you. I've been telling you about my experience and what I see coming, and I hope you listened. But as always, I would not have listened to me either. So sometimes you just got to go through the pain yourself. Hopefully your pain is not a loss of 80%. Hopefully hopefully you sold, but hopefully you get out before an 80% loss. This is not over. To that end, we saw Netflix and Peloton lose it. And then I saw that Shopify lost it. Shopify is interesting, right? Not that I'm recommending the stock, but it's interesting. They apparently dropped because they were terminating fulfillment partners in warehouse contracts. That may be a good or bad thing. It may be like Peloton, where they're cutting capacity, or, big capital or, Shopify could be going on the hunt for their own space, right? Be more vertically integrated. The couple of articles that I read on that, I don't know which way it's going to go, but I do think Shopify is a choice. Peloton is clearly demand fall off a cliff, cost structures whacked. They gotta reduce headcount, big marketing spend, all bad, right? Peloton, no bueno. Shopify, I am not sure. So we shall see what's going on there. Looks like GM, who was it? Intel, I think, just announced a $20 billion plan in Ohio. Looks like GM is dropping $6.5 billion for a factory in Michigan. So it looks like more and more manufacturing is coming home. This is likely going to be part of the decade. This is, again, what I've called. Unfortunately, bringing manufacturing home is not as fast as any of us would like. I think we have a lot of pain. I've been telling you or advising you for the last 6 or 9 months that you should be researching the 1970s. As I put in the title of this video, the 1970s suck. I've spent the last 2 or 3 days talking with folks of my parents' generation who really lived through the 70s, and all of them said, not fun. It was a horrible decade. So again, I think we should appreciate history. It won't be the same, but it may be similar. But again, there are some things I've been trying to put out there telling you what's coming. A lot of it is happening right now. So it feels good to be right, but I realize that some of you are feeling pain, and I'm sorry for that. Next up, look, it's interesting. Some people are reaching out saying we are in the crypto winter. If you don't know what that is basically where crypto goes down 50 to 80%. I actually think you might be in a crypto ice age. Again, if you know anything about me, about 15 months ago, maybe 18 months ago, I moved 1% of my assets into crypto, Bitcoin, Ethereum, for example. At the time, I told you it was just an insurance policy. I don't really look at it except when it pops in my radar. It is still there. It is still 1%. It's an insurance policy. It's not going anywhere, not adding, nothing like that. But yeah, I think you might be experiencing a crypto ice age, because I think just like the meme stocks, just like all these BS SPACs that the Wall Street was force feeding you, I think there was a lot of this was stimulus fueled. And I think a lot of you are getting burned right now, and worse yet, getting wiped out. It'll be interesting to see on Monday how many crypto traders were margin called to zero. That is happening right now. So again, I don't know why anybody would buy crypto on margin. That just seems foolish. So I think you're going to see a lot of people lose interest. It'll just be like the dot-com era. Yes, for every Amazon, there are a dozen that don't exist today. Everybody wants to talk about Amazon, being born and thriving and going through, but there's dozens that went to zero. And I think we're going to see lots of that stuff in the crypto space. So be careful. The 1970s, obviously very inflationary. I think the best case we can hope for the next 3 or 4 years is stagflation, where incomes go up, but real incomes go down. There's obviously a difference in that, nominal versus real. And one is inflation adjusted and the other is not. So be very, very careful. The week ahead is going to be all about the Fed. It's going to be all about the Fed. The Fed releases their statement on Wednesday. I think it's at like 11:30 Pacific, so 2:30 Eastern. It'll be during the trading day. That ought to be interesting. On top of that, we have lots of earnings and economic data to watch. So on the earnings front, we got Halliburton and IBM Monday. We have Tuesday's a pretty big day. We have General Electric, Microsoft, J&J, and Amex. Of those four, Amex is the one I'm watching the most. Amex is going to give us a feel for travel, is going to give us a feel for business spending, right? A lot of folks in the business arena use Amex as their way to go forward. So again, this is very, very interesting. On Wednesday, we got the darling of Tesla. Tesla coming out. It'll be interesting to see what they have to say about their gigafactory in Germany. I am pretty sure their numbers are going to be just fine, but it is going to be about next quarter. What we are seeing in the earnings, and I told you it was coming, it's not about Q4. It's about forward-looking guidance. And you never know, Tesla might say, chips are an issue, dead days like we talk about in construction. It could hit manufacturing plants, shipping stuff all over the world via planes versus boats. We don't know. Then we have Intel. Intel's coming out. And of course, the Fed meeting, yes, I have it down here at 11:30 Pacific, 2:30 Eastern is the expected Powell talking. Thursday, we got Apple. Apple will be very interesting to see what's going on. And McDonald's as well. And then Friday, we have Chevron and Caterpillar. So it is very, very interesting. As far as economic data, a lot of stuff coming out next week. We have Case-Shiller, which is often quoted, but frankly, almost useless, right? It's January. They'll probably be giving us October, maybe November data. It is months behind. FHFA will be interesting. That is more recent price data, more interesting. And then consumer confidence. I think this consumer confidence reading is going to be interesting. It was likely taken right before we've had some stock market gyrations. So the next one might even be more interesting. But yeah, it is going to be, consumers is what it's about. It just is. It's what I've been studying for 30 years. And I think the consumer is starting to crack. And I actually indicated that a couple months ago. I think we're going to start to see it. New home sales, what is going on? New home sales is probably going to miss, right? Dead days, lack of this, lack of that. I mean, you can't You can't sell a new home without it being complete. And then initial jobless claims on Thursday. Q4 advanced GDP. This is our first look at Q4. I expect it to be good. I expect Q1 to be bad. But yeah, Q4 GDP. And then pending home sales. What is going on with pending home sales? I suspect that we're going to see a lot of first-time home buyers jump in, a lot of them overpay, a lot of them getting spooked by rising rates, and ultimately have buyer's remorse, which will be very sad. I expect the next 6 to 10 weeks to be very dicey for us as investors, because again, you have this whole pool of first-time home buyers that are now scared or spooked. They are going to do unhealthy things and overpay. So again, watch your numbers, only do good or great deals. If you get outbid, you get outbid, there will be another one. This is gonna go about 6 on the short end to 10 weeks. So certainly all of February, we're gonna see first-time home buyers doing interesting things. And then finally, Friday, we have consumer sentiment. So consumer sentiment is out on Friday. A couple other things we talked about. Looks like MicroStrategies is getting slapped by the SEC. Looks like MicroStrategies tried to report some Bitcoin gyrations on their income statement. The SEC has said, please don't do that again. So again, you will not see the up or down on their earnings statement. Looks like there's a lot of fear right now that Russia will invade the Ukraine. I am curious. What do you guys think? Do you think it happens? Do you think it happens this month? Do you think it doesn't? Just curious. But if they do, this is what happens, right? If Russia invades Ukraine, big if, fear goes up. 10-year goes down. 10-year rates go down. People rush to cash. You will probably see selling in assets as people try to get to cash and dollars. So again, if it happens, it will be a quick, sudden reaction. People will do this quickly and then they will reevaluate once news comes out. So the Fed meeting. I think it's pretty clear that the Fed is going to raise rates. 95% of people think it's going to be a quarter. I am in the 5% camp that think it's going to be a half. In fact, I'm the first one that I know of to call a half a point 4 or 5 months ago. I'm standing with that. We'll see what happens. I'm curious though. Most people think that the Fed doesn't have a backbone. So if the Fed doesn't have a backbone, at what point do they stop raising rates? Is it 20%? If S&P falls 20%, do they chicken out? Is it 30%? Do they chicken out? 40% or 50%? Let me know in the comments below. I want to hear from you. I actually don't know what I think. I hope they don't chicken out because again, the pain that we have is something we have to pay or we pay with interest later. And then finally, the 1970s suck. Again, I put together a 50-year spreadsheet. I give it away for free. But let me just summarize some of the data in there. We are going to compare a decade from 1973 to 1982. The spreadsheet has lots of data over 50 years. We're going to take that decade across 4 metrics because you need to pay attention. First, if you are a stock market investor, the S&P 500 over a decade did nothing. It was 118 January 1st, 1973. It was 117 January 1st, 1982. Folks, that is the definition of dead money, a decade of dead money. 10-year Treasury, again, 10-year Treasury, it was 6.46% January 1st, 1973. It peaked, on January 1st, 1982, the 10-year Treasury was 14.59%. Now, folks, I'm not sitting here telling you that 10-year Treasury is going to go to 14%. That would be ludicrous. What is important to understand is the 10-year Treasury can double. Looking at this very quickly, that's actually like 115%. It went up 115% from 6.5 to 14.5. The 10-year treasury is going up, and it went up over a decade. That is something to pay attention to. Now, housing. Remember, S&P went down a point in 10 years. What did housing do? Remember all these real estate channels. They keep telling you, if interest rates go up 1%, housing has to crash 10%. Well, interest rates went up 800 basis points. So isn't housing supposed to fall 80%? Maybe housing's not supposed to fall 80%. Maybe it's only going to fall 50%. Folks, you are so out of touch because there's a third variable we will get to in a minute. Houses, 1973. You can look this stuff up in Google. The average house was $32,500. You know what the house was worth in 1982, 10 years later? Remember, 10-year treasuries up 800 basis points. S&P 500 does nothing. Housing, $69,300. Housing went up over 100%. It did not fall 20, 30, 40, 50, or 80% as these idiots on YouTube want to say. And then finally, why does this happen? Income. Income, income, income. Income in 1973 for a family of four was roughly 12 grand. Yes, it's hard to believe, but that's what it was. You can look it up on Google just like me. And by 1982, it was just shy of $24,000. So income doubled in a decade, housing doubled in a decade, stocks did nothing, and interest rates went up 800 basis points. Folks, again, it's not going to be the same, but it will be similar. Do the work. Learn your market. Don't be spooked out by people that make crazy claims that have not done the work. I've been investing in real estate for 21 years. Do the work. Always a good day to do a good or great deal, but you won't know a good or great deal until you do the work. If you need help with that, there's a great course below called How to Get Started One Rental at a Time. Thousands of students have done it. We have over 1,100 people in the private Facebook group. Join the group, do the work, stop being a spectator, stop listening to naysayers who own nothing. Get in the game, do the work. Again, remember though, the next 6 to 10 weeks are going to be hard, but it is a great time to learn what is going on. And at the end of the day, I see a comment from Chester. Yes, even though housing doubled, it was still affordable. My 50-year spreadsheet shows you exactly how much. Housing is about affordability. This book right here, One Rental at a Time on Amazon, is a must read. The affordability index told me when to sell my houses. I did. We got apartments. Then housing crashed, and then we bought housing again. It is all in there. 15 years from having nothing and reading Rich Dad Poor Dad to replacing 2 six-figure incomes. Go get that book right there. All right, everybody, take care. We will be doing a live stream in 12 minutes. Bring your questions. If you just want to say hi, I will do my best to recognize you as well. Take care.